In today's presentation, I'll be talking about seasonal trading in the stock market. The assumption with seasonal trading is that there are underlying factors that move markets on a periodic and regular basis, whether it be yearly, monthly, or weekly. The first example I'm going to talk about is the sell in May and go away rule, where you don't want to be invested in stocks from the month of May through October, and you do want to be invested in all the other months. And the other example I'm going to be talking about is the turn of month effect, where you want to be invested in the stocks during the last 4 days of the month and the first 3 days of the following month. And the turn of month effect is a very well researched anomaly, and there are many academic papers on this. I'm going to put a link to one of these papers in the description box below if you want to look at it. So the first system we're going to look at is the sell in May and go away. The black line here is the VFINX, which is the Vanguard 500 Index Fund, representing the S&P 500. And the light blue line is the sell in May, go away equity curve. And what we can see is that they're both pretty close in terms of return magnitude. The seasonal model makes 10.2% compounded annualized rate of return over those years. This goes from like early 1980s to present day, whereas the buy and hold makes 11.4%. And what you can see though on the drawdown graph is that the buy and hold had a max drawdown of more than 50%, whereas the seasonal rule only drew down around negative 30%. So the takeaway here is that you can get pretty similar returns with only a fraction of the risk when using this particular seasonal rule. And here we look at how the seasonal model compared to the buy and hold portfolio during various stress periods over the decades. So the Black Monday period, which was in late 1987, seasonal model lost 8%, whereas buy and hold lost 30%. During the Asian crisis of 97-98, the seasonal model was not invested in the markets at that time, whereas buy and hold was down about 6%. During the Russian debt default of 1998, model again was not invested, whereas buy and hold lost 15%. And during the dot-com bubble of 2000 to 2002, seasonal model lost 18%, whereas buy and hold was down 45%. During subprime from 2007 to 2009, seasonal model was down 30%, whereas the buy and hold was down 51%. And during the COVID crash, which was, Jan to March 2020, they both were fully invested, so they both lost 19.6%. And I also did this analysis on the small cap stocks, which is basically the Russell 2000 index. Here we use the Vanguard small cap index as a representation of that, ticker symbol NAESX. And that's the black line. And we can see that the seasonal rule of sell in May and go away actually outperforms the buy and hold index for the small caps. And on the drawdown side, it's much better as well. The buy and hold drew down like 55% at one point, whereas the max drawdown for the seasonal rule is around 35%. And the Sharpe and Kalmar ratios are better as well. Kalmar is the return over drawdown metric. And we have the various stress periods over the decades, but I'm not going to go over it. It's just the same as the S&P. It generally does better than buy and hold. Now I'm going to look at the turn of month strategy for the S&P 500. The rule here is to be invested in stocks during the last 4 days of the month and the first 3 days of the following month. Why does it work? Well, there are things like timing of corporate earnings releases, portfolio adjustments by institutions, and the increased liquidity because of monthly paychecks being invested in the stock market. These factors can combine to create a temporary boost in stock prices. So here's the backtest of this particular rule on the S&P 500. The gray line is the buy and hold S&P 500, and the pink line is the turn of month rule that was just described. We can see that it is a lot smoother than the buy and hold, and it sidesteps a lot of the drawdowns. And if we look at the drawdown curve here, the max drawdown of the buy and hold index is more than 50%, whereas for the turn of month strategy, it's just hovering around negative 20%. So it's pretty good. Now, if we look at the compounded annual rate of return of this seasonal rule, it's 5%, but with the buy and hold, it's 9.2% over this time frame. But if we look at the exposure adjusted rate of return, it's 19.7%. And how I calculate that is with the seasonal strategy being invested a few days before and after the turn of the month, you're in the market maybe less than a third of the time. So what you need to do is adjust this 5.1% up to reflect for that brief time in the markets. So that comes out to around a 19.7% exposure adjusted return. And that can be compared to the exposure adjusted rate of return of the buy and hold, which is 9.2%. So it's much better return. And the return to drawdown ratio is better as well. It goes to 0.25, whereas the buy and hold is 0.18. Now I do another enhancement upon that rule. And so what I do is, first I modify the hold period from negative 4 days to plus 3 days around the turn of the month to negative 3 days and plus 5 days around the turn of the month. So you're entering a little later in the month and you're exiting a little later the next month. And I also add a trend filter on top of this. And that is if the 50-day moving average of the S&P 500 is greater than 200-day moving average. So this is the standard golden cross filter. If that is true, then you want to use a 2x leveraged mutual fund or ETF. But if this golden cross filter is not true, then you just buy a 1x ETF or mutual fund. So a 2x ETF would be SSO, and the 1x would be, of course, the SPY. And by doing this, you can see that the exposure adjusted compounded annual rate of return, which I described in the previous slide, jumps up to 37.5%, which is pretty good compared to the 9.2% buy and hold rate of return. And the drawdown, the return to drawdown ratio is 0.42, whereas it's 0.18 for the buy and hold. I have also created a spreadsheet which I have available for download at this URL. I'm going to paste this URL in the description box below, but I've made it available on my website. You can download it and you can actually play with the various parameters and see how you can improve upon it. And here it is. So for example, this one has the original days set for before the end of the month and after the end of the month. But let's say you wanted to change the -4 to -3 and the 3 days after month to 5 days after the month. You can see that you can already improve the performance, and you can play with different parameters here, and you can also input different stocks or indexes in this column. Just paste it and see whether this rule works better on other assets than the S&P 500. In summary, the turn of month strategy is a persistent anomaly in the worldwide equity markets. Seasonal filters enable more selective exposures, and a portfolio of seasonal rules can aggressively boost returns. One can combine seasonals plus trend overlay plus leverage to enhance performance and risk-adjusted measures of a portfolio. So that's my presentation. Thank you for listening. If you want to download that backtester spreadsheet, please go ahead and visit my website. I'm going to paste the link in the description box below. Thank you.